Stocks tend to make their most explosive gains during the start of a new bull market and the end of a bear market. So if you are an investor or trader, one of the most profitable times to be in the stock market is at the end of a bear market or a market correction and a start of a new bull market. So one of the most important questions for us as investors and traders in the stock market is how do we identify a potential market bottom? So in this video, I want to share with you how you can identify potential market bottoms using this thing called the follow-through day. But before we begin and talk about the follow-through day, if you are new to this channel, my name is Linus, and in this channel I share all things related to the stock market, so both investing and trading. If you want more videos such as this, make sure you subscribe to my channel because each week I release 2 new videos about investing, trading and the stock market. Alright, so let's begin. So the first thing that we'll take a look at is why is a follow-through day important? As we have mentioned just now, stocks tend to make their most explosive gains at the start of a new bull market and at the end of a bear market or a market correction. So if you are an investor or a trader, the time during the end of a bear market and a start of a new bull market is usually when you can make the most gains. So that's why a follow-through day is important, because a follow-through day allows us to identify potential market bottoms after a bear market or a market correction. So the next thing we'll take a look at is what is a follow-through day. So a follow-through day is a term coined by William O'Neill. William O'Neill was a very successful investor in his days, and he was also the founder of IBD or Investors Business Daily. After spending years and decades studying and researching about the stock market, William O'Neill found that more times than not, when a market changes direction from a bear market or a market correction, or in other words a downtrend, to a bull market or uptrend, there tends to be a follow-through day in the stock market index. So William O'Neill coined the follow-through day as being able to help investors and traders identify an important change in general market direction from a definite downtrend to a new uptrend. And these are the 4 characteristics of a follow-through day. The first characteristic is one of the major market indexes, so either the S&P 500 or the Nasdaq. So you'll see later why we only use the S&P 500 and the Nasdaq and not the Dow Jones. So the first characteristic is one of the major market indexes, so either the S&P 500 or the Nasdaq, rallies and closes higher than the previous trading session or closes higher after decline earlier in the day. The second characteristics to identify a follow-through day is that the follow-through day must happen at least 3 days after the initial rally, so day 4 and onwards. The third characteristic is that the market index must increase by at least 1.25% for the day. And for the fourth characteristic, volume on the follow-through day must be heavier than the previous session and also ideally above the average volume. And this is why we only use the S&P 500 and the Nasdaq, because as you can see over here, we need to take into account volume, and there isn't any volume for the Dow Jones. So when we are talking about the major market indexes, take note that we are meaning either the S&P 500 or the Nasdaq. So these are the 4 characteristics to identify a follow-through day. Now let's take a look at the individual characteristics in greater detail. So for the first characteristic is the attempted rally or day 1. So on day 1, we want to see one of the major market indexes rally and closing higher than the previous trading session. So what that means is that imagine that the market index is still declining and in a bear market or in a market correction. So when the market index is declining, we see red candlesticks or bearish candlesticks as indicated on the screen. So what we want to see on the attempted rally or day 1 is a green candlestick or a bullish candlestick whereby the prices for that day close higher than the previous trading session. If you are not too sure about candlesticks, you can check out my video over here where I share with you how you can read and interpret individual candlesticks and also the different candlestick patterns. But basically for a red candlestick, the opening price is higher than the closing price. So for this candlestick over here, the opening price is at this point over here and the closing price is at the bottom over here. And for a green candlestick or a bullish candlestick, the opening price is at the bottom over here and the closing price is over here at the top. So what we want to see on the attempted rally day is prices closing higher than the previous trading session. So for this candlestick over here, the closing price is here, and for the previous bearish candlestick, the closing price is over here. So the closing price for this attempted rally day is higher than the previous trading session. So that's the first thing that we want to take a look at. Another way to identify a attempted rally day or day 1 is to see the index closing higher after decline earlier in the day. So how this looks like is this candlestick over here. So for this candlestick over here, prices open at this price over here before prices decline all the way to this intraday low. So this was the earlier part of the day. But towards the later part of the day, buyers managed to step in and push prices up to close at this upper level over here. So on an attempted rally day or day 1, we want to see the market index either fulfilling one of these 2 criteria. The second thing that we need to pay attention is to identify the follow-through day. And the follow-through day must take place on day 4 or after. So on the 4th day onwards, look for a trading session to display strong gains and volume. So a follow-through day can happen any day after the 4th day. but the most powerful follow through usually occurs between the 4th and 7th day. And for the third characteristic, on the follow through day, we want to see the gains for the follow through day to be more than 1.25%. For the fourth characteristic, we want to see strong volume. So on the follow through day, the volume on the day has to be higher than the previous trading session and also ideally above average volume. So this is a recap of the 4 characteristics of a follow through day. So for the first characteristic, we want to see one of the major market indexes. So either the S&P 500 or the Nasdaq, or both indexes. In this case, if both major market indexes display the follow through day, it increases the probability that there is a market bottom and the start of a new bull market. So we want to see the major market index rally and closing higher than the previous trading session or closing higher after decline earlier in the day. That's the first characteristic. The second characteristic is we want to see the follow-through day happening at least 3 days after the initial rally, so day 4 and onwards. The third characteristic is that on the follow-through day, we want to see the market index increasing by at least 1.25%. And for the fourth and final characteristic, we want to see volume on the follow-through day being heavier than the previous trading session and also ideally above average volume. Okay, now that we know all of the characteristics of a follow-through day and we know what to look out for, let's use it on our actual price chart. So we'll first take a look at the S&P 500. So this was the S&P 500 back during the pandemic crash. So over here you see the S&P 500 declining and going into a bear market territory. And as prices decline over here, we had the attempted rally day over here or day 1. So remember the first characteristic of a follow through day. So for the first characteristic, we want to identify the attempted rally or day 1. And for day 1, we want to see prices closing higher than the previous trading session. So over here, prices close at this price level over here and above the previous trading session's closing price. So that's the first characteristic. The second characteristic we want to see is we want to see the follow through day happening on the 4th day and onwards. So this is the first day, second day, third day and 4th day. So starting from the 4th day, we want to look for the third and fourth characteristic. The third characteristic is we want to see the S&P 500 making a gain of at least 1.25% for the trading day. And the fourth characteristic is we want to see the volume for the day being higher than the previous trading session and also ideally above the market average. So is this day the follow through day? No, because as you can see for the volume over here, for this volume on this day was lower than the previous day's volume. So it doesn't fulfill the third characteristic. So we move on to the next day. For this day, volume was also lower than the previous trading session, which was on this day. So this candlestick over here was not the follow through day. And for the next 2 red candlestick day, those are not follow through days. And we don't even have to take into account the volume. Because for those 2 red days, they don't fulfill the fourth characteristic, which is that we want to see the S&P 500 making a gain of at least 1.25% for that day. So these 2 days are not follow through day. And is this day a follow through day? No, because even though the S&P 500 did make a gain of 2.31% for that day, you can see that volume was lower than the previous day's volume. So this was not a follow through day. Neither is this one, because for this day, the S&P 500 declined and did not make a gain of more than 1.25%. And we finally had our follow through day on this day over here. Firstly, we already had the attempted rally day. So that's the first characteristic being met. The second characteristic is that the follow through day must happen on day 4 and onwards. And this is definitely more than 3 days after the attempted rally day. So it meets the second characteristic also. For the third characteristic, we want to see the S&P 500 making a gain of at least more than 1.25%. And you can see that for this day, the S&P 500 made a gain of 6.72%. For the fourth characteristic, we want to see volume being higher than the previous trading session. So as you can see over here, volume on this day was higher than the previous day's trading session volume. And then you can see that on this day also, volume was also ideally above the market average. So it meets all 4 criteria and characteristics. So this was the follow through day. And as you can see on hindsight, after that, the market really took off and recovered from the bear market bottom. So using the follow through day, it did help us identify the market bottom in the pandemic crash of 2020 and also the start of a new bull market after that. So let's go back to where we are currently at right now, because right now the market is in a correction. So we'll use this follow through day to determine whether the market has recovered from the correction. So over here for the S&P 500, we see that the S&P 500 declined and it was in a market correction territory. And then we had the first attempted rally day on this day over here. So why was this the attempted rally day or day 1? Because if we take a look over here, prices opened for the day at this price level of around $430 before it went down all the way to this level over here. And then the buyers stepped in and then managed to close prices above the low of the day and even above the previous trading session's closing price. So this was our day 1. And then for our follow through day, we want to see the follow through day happening on day 4 and onwards. So this was day 2, day 3 and day 4. So for this day, this wasn't a follow through day because we can see that prices for that day declined by 0.49% and not increased by at least 1.25%. So this wasn't a follow through day. And then for this day over here, was it a follow through day? Yes, because it fulfills the criteria. So the first criteria that it fulfilled was that it was day 4 and onwards. The second criteria that it fulfilled is that prices for the day increased by 2.48%, so more than the 1.25% that is required. And then for the last criteria, it also fulfills the last criteria because volume for this day was 164 million compared to the previous trading session day where volume for this day was higher than the previous trading session. So volume on this day was 164 million compared to the previous trading session of 149 million. So we had the confirmed follow through day on this day over here. So does this mean that the S&P 500 has reached its market bottom? Well, based on probabilities, having a follow through day after a market corrects gives us a higher probability that the market correction is over and the bull market or uptrend is resuming. So that's the follow through day explained. Hopefully you have enjoyed and learned something from this video. If you did, smash the like button because it will really help the channel grow and allow me to produce more content such as this. And if you want more weekly stock ideas and tips, make sure you join my Facebook and Telegram groups because I share weekly stock ideas and stock news on those groups. You can join those groups by clicking on the link down in the description below. I'll see you in the other videos to your financial success.